Welcome, everyone. As I was saying, Alex has spoken. He gets the MVP of Rev. He's spoken at 3 of our last 4 conferences. I can't think of anyone else other than maybe Nick who has that record. And so this is a treat, in part because he's changed a little bit what he's focused on. Prior to what he's doing now, CEO of Cybersyn, he built one of the best data practices on Wall Street. I say one of the best because I was building one of the other ones, and so I have to be a little bit competitive with him. So maybe between the 2 of us, we had the 2 best. He was at Co2, and one of the leading experts in the world on alternative data and how to apply that to public market and private market investing. He left there to start a company, which he's the CEO of, where he's using some of these same thoughts around alternative data to help kind of a different audience and different crowd. So he's going to talk today about data strategy and tell us a little bit about that business. And I, for one, am very excited. So welcome, Alex.
Thank you, Matthew. It's great to be back at Domino Rev, and congrats on the 2nd best Wall Street data business. So in this talk, I sort of want to do something a little bit unusual. I want to start by going into a story about hedge funds. And this is kind of going to rhyme with Matthew and my experience in the hedge fund industry and how external data transformed sort of how hedge funds investors do research. And then I want to tie that back into some of the problems or opportunities that exist with AI today. And around sort of how external data could be a key way to differentiate yourself when training AI or when building an AI strategy. And throughout the end of that piece of the talk, I'll talk about how to get started and a little bit on what I'm spending my time doing, what my new company does, and so on. But before we get to that, just a little bit about myself, so you know who's sort of talking at you and is between you and sort of the weekend here. So. I spent 6.5 years at Co2, the majority of that time leading the data science practice. I joined right out of college. Basically, Co2 was just starting off their data practice, and I had the opportunity to sort of run that. Co2 grew from a $12 billion fund to $50 billion plus in the time I was there. We were technology investors investing in public equities primarily, but also in private venture startups. And actually, the way I got to know Domino beyond being a customer was we were an investor in Domino, and it was sort of the first investment I championed at Co2. So Domino will sort of forever have that special place. And then I started something new this year, or in 2022, and that's this new company, Cybersyn, that's funded in part by Co2 and in part by some other folks in Sequoia and Snowflake. I'll talk a little bit about that, but that's me in a nutshell. So let's start with the story about the hedge fund industry. Right? And this is really where I spent the majority of my career. So traditionally, right, hedge funds were kind of split into 2 camps. There's this discretionary camp and there's the quant funds. You've probably all heard of the quant funds: 2 Sigma, Renaissance Technologies, AQR, PDT, parts of Citadel. These are the folks who are making statistical models to predict where prices are going, right? And this is, really this industry grew up in the 90s, and this is where people took astrophysicists, math PhDs, and sort of, without knowing anything about finance, kind of taught those folks to make predictions as to where the price was going the next minute, the next second, the next day, the next month, right? And that's been around forever, that type of data science, again, since the 90s. And then separately, the other part of the industry, and frankly, the bigger part of the industry, was what I would call discretionary funds, right? And so this is like what you think of when you think of hedge funds on Wall Street, right? These are the folks who are mostly using Excel models, who are looking at individual businesses, talking to management. They're making decisions like, hey, I think Apple's new product is really good, and so we should buy the stock. Or I think that Apple is disadvantaged or Google is disadvantaged in the future because of AI, and so they're not a good buy, right? It's very discretionary, high-level decision making, and then Excel models to sort of power that. And so, one thing that changed, and this is kind of predictable, is we went from martini lunches and Excel files to a more data-driven approach. And effectively what happened in the late 2000s with the great financial crisis and the early 2010s was sort of partially driven by competition and partially driven by regulation. So, equal disclosure laws in the United States around the stock market were not enforced as strictly before kind of the early 2010s and the famous kind of insider trading cases around expert networks and so on. And traditionally, the way hedge funds would sort of differentiate, right, would be based on relationships with customer management, based on relationships with customers, based on relationships with IR teams. And this sort of all went away, right? It became very standardized, and it was ultimately good for the financial industry. But it did mean that a lot of funds had to think, OK, well, how are we going to be different? We're all hiring the same people from Yale and Harvard and sort of the same degrees and the same pedigree, right? How are we going to be different? And this is kind of what gave rise to what became known as alternative data. So traditionally, hedge funds would always look at financial reports, press reports, interviews, surveys, things like that. This was traditional data. This is the realm of S&P, Bloomberg, FactSet, right, MSCI. This was kind of traditional data. And this data was consumed by quants primarily to do these statistical models, and consumed to a lesser degree by discretionary funds to sort of do this kind of like Excel-based analysis. And what alternative data was, it was a way to find non-traditional alternative or different data sources. But so it was just alternative to market data, right? And these data sources are really focused on what is actually going on in the economy. In some sense, they're very similar to what the US Census or the Fed or the BLS or BEA do. They measure what consumers and businesses are doing in real time in the economy. And they try to give you a sense of what's happening, right? And they can be used to answer short-term questions like, how much revenue is this company going to generate this quarter? Or they can be used to answer long-term questions like, what is the lifetime value of a DoorDash customer? Or how does Netflix's retention curve compare to, say, Hulu or Disney Plus? And so you can answer both like tactical questions and very strategic questions. And these questions are, they make business sense, right? They're not, theoretical. They're not mathematical. They actually relate to those Excel models, right? And I think that this suddenly opened the eyes of traditional discretionary investors to build data science teams. And this is kind of the experience that we had at Coatue, but many other funds did this at the same time. I mean, Point72 is another great example. And suddenly it became necessary to hire sort of a new type of quants, right? And it like centered around this kind of alternative data concept, if you will. So just to go into some examples, because I think it's helpful to illustrate like what does this really mean. So a famous example that pops up in the Wall Street Journal like every 2 years is satellite imagery. So essentially, there's enough satellites covering the Earth that are commercially available that allow you to take photos of basically any spot on the world and extract something from those images. So the obvious examples are factories, right? If a factory produces buses, as long as you can take a picture of that factory every day, you could probably see how many buses are being produced or rolling off that lot. Parking lots, you could count the number of cars in a parking lot so long as you take a photo at the same time of day, you don't have cloud cover, there's all these assumptions. And then other things like commodities or agriculture. I mean, the oil example is really fascinating. So commodities traders use satellite data to measure oil storage. And the way oil is stored onshore is basically using these like large cylindrical containers, if you will. And these containers have floating tops that float on the oil. So as the container fills up, this lid kind of goes up and down. And some of these commodity traders, what they figured out is that casts a different shadow depending on how high or low that lid was. And so you could measure how much oil was on onshore oil reserves using photos from the sky, right? And it was this kind of creative approach, right? You can imagine you could do the same thing with agricultural yields. How green is the field, and what does that mean for yields? Another example that became very popular is real-time consumer card data. So the vast majority of transactions today are digital, and they're not just digital. They go from the customer to a merchant that goes through a payment gateway. There's a customer bank, there's a merchant bank, there's a payment processor, there's a merchant acquirer. And so there's a lot of digital footprints of basically every transaction we make. And it turns out that some of those folks properly obtain consumer consent and in many cases merchant consent, in order to share that data with people looking to make investment decisions. And it's not PII, it's anonymized. In many cases, it's aggregated. But nonetheless, it can provide a really fast view into what is happening in the economy. And one example I want to give is taking you back to the dark days of March 2020. For those of you who are in New York, you remember that as particularly painful here. And if I take you back to mid-March 2020, the stock market was basically collapsing, right? Think March 15th, March 16th. There was huge uncertainty. And I think that nobody knew what was going to happen. One thing you could see in these types of data sets, though, were that consumers were rapidly shifting their spending to e-commerce and to online spending. And they were buying goods and furniture online, right? And looking back, this is obvious, right? People are staying at home. Of course, people are going to buy furniture. They're going to furnish their spaces and so on. But 2 weeks into the pandemic, this was not obvious at all, right? There was people predicting that we would have a massive long-term recession, that all retailers would close, that it was extreme uncertainty. And as an investor, if you want to understand, well, what is the impact going to be on GDP, having a fast real-time view into what was going on was tremendously helpful, because government statistics and figures didn't come out until well into April. And again, that's not just useful for investors. It's also useful for policymakers, right? When you think about implications of job creation or job growth, understanding how consumer spending is changing and how consumer savings are accruing or not, or draining, would have been useful, right? And so I think that in many ways, these kind of investors have built up an industry, a cottage industry around this concept of alternative data. And hedge funds, by the way, are advanced, but they're not entirely unique from other industries. And so when I say that they're advanced, I just mean that most industries have spent the last 10 years building internal data science teams. So they've hired the talent, they've built the infrastructure, they've gotten very good at taking their internal data and doing something with it, right? So the famous example is Netflix, right? They use your viewership data from the Netflix product to recommend to you what to watch next, right? Investors never had that option, right? The business of investing is looking at other people's companies. Research and outside-in views of other companies is the whole point, right? And so external data naturally developed there at maybe a faster clip than it did in other industries. That said, it does exist in other industries. And it's traditionally been very verticalized, right? So in CPG, you have Nielsen IQ and IRI. In real estate, you have CoStar and Black Knight. In pharma, you have IQVIA. And so traditionally, you've probably never heard of IQVIA unless you've worked in healthcare or pharma. But it's $40 billion market cap company, right? Same with CoStar, right? These are very verticalized specific things. But in some ways, there's actually crossover that could happen if people knew about these different data sets. So let me give you an example. If you were a pharma company, you probably care a lot about site selection, which is this concept of choosing where to have clinical trials. Where do I find patient populations that meet some criteria? And often these criteria get very specific, right? They're like, I want people with sugary diets that eat hyper-processed foods and eat out 5 times a week or something, right? You want some specific very criteria. You want to know which doctors do I go to, who can actually enroll patients. And so certainly the IQVIA data is helpful. Getting healthcare claims data, getting drug prescription and sales data is useful. But consider that Nielsen IQ and IRI basically have the best data set in the country on what everybody eats, right? Because they see in the grocery store and they see what cereal people are buying and how much of that cereal and how does that differ across markets, right? And so I think in some ways, even though these industries have been traditionally verticalized, there's no reason they couldn't cross over. And naturally, investors, which invest in all sectors, right, sort of touch all of this kind of data. I think the key challenges that have emerged in external data, not just among hedge funds, but broadly, is discoverability. So how does the pharma firm even know about Nielsen IQ, right? It's the most opaque, confusing industry ever. And by the way, there's 2 Nielsens. There's Nielsen, the media company, and Nielsen IQ, the CPG company. And you probably don't know that unless you work in media and or CPG, right? So the discoverability problem is big. The second piece is prices are opaque. How much do you pay for a satellite photo of a parking lot? Is it $10,000 a year or is it $100,000 a year? It's pretty arbitrary, right? And there's no, again, these things are sold in the sort of like negotiated martini lunch sort of way. There's no fixed prices. And so it's, understanding how much your data is worth if you wanted to monetize it is very difficult. And then the last piece is compliance. And this is tremendously important. I think whenever I mention data sales, people jump to data privacy, right? So they jump to, OK, are we violating somebody's privacy? Isn't this like Cambridge Analytica, right? And that is certainly true. I think the FTC has a lot to say about those kinds of misuses of data. And I think we lack in the United States a federal privacy law. And instead, we have state-level laws in certain states like Vermont or California, as an example. Europe has a centralized privacy law. And so privacy is definitely a concern. But there's other concerns as well that maybe don't come up to most people at first glance. For instance, there's the MNPI, Material Non-Public Information concern, that mostly comes from the SEC. So how do you ensure that the chain of custody of data you get, right? Nobody has violated a fiduciary duty, misappropriated data, or committed fraud to sort of acquire that data. That the people selling you the data, or anybody upstream of you, actually has the right to sell you that data. And that goes all the way back to the consumer, that the consumer has kind of consented, right? So that's another issue. So I think a third issue that comes up is antitrust, right? So there's certain industries that choose to pool data together, but then how does that pool not lead to collusion, right? And so there's all types of challenges that sort of remain to be solved. Nonetheless, I think in general it's a very interesting space. So now the other part of the talk, the other half, switching to AI. So the number one question about AI is who actually wins, right? So there's all these incredible like vaporware demos that mean that maybe we don't need humans anymore. Maybe our marketing copy will be written by AI. Maybe like you'll type into new Google any question and you just get the answer. You don't even have to click a link, right? But who wins? And I think that this is a question that has plagued investors, operators, incumbents, and startups, everybody. So I think it's clear that chip manufacturers are probably well positioned. If you're NVIDIA or TSMC, chances are you're going to be producing a lot more chips, right? And I think that's ultimately sort of a winner. A second seeming winner, it's too early to know, but I think likely would be like the hyperscalers. So the Amazons, the Googles, the Google Clouds, the Azures, right? So if you provide the infrastructure similar to the chips, maybe even just like one level higher, then chances are you're sort of well positioned and people will need more infrastructure. But who else, right? I think it's a little bit unclear so far. In some ways, there's all these new startups popping up, but these new startups are a thin layer over GPT or over OpenAI, Anthropic, and so on. And so what's really the moat? And then on the other hand, you've got incumbents that have distribution already, right, and are incorporating AI into their products. I mean, the Photoshop example from Adobe that was recently made public is very impressive. And so maybe they have the advantage because they already have the distribution. And then the third consideration is, what about the model builders, the Anthropics, the OpenAIs, the models as a service? Well, maybe. I mean, certainly everybody's using them and paying them a lot. But on the flip side, it seems that a lot of these open source models are catching up. And every time Anthropic or OpenAI releases a new model, somebody reverse engineers it and publishes an open model in Hugging Face that does almost just as well, right? So who's really going to be the winner? And you could sort of maybe see where I'm going with this. But before I go there, let me just talk about some downsides to LLMs. And I think these downsides lead to my conclusion. So first, hallucinations occur, right? So you can ask an LLM a question like, what is the GDP of China, right? And you could get an answer like, the GDP of China is 5%. But you don't know for sure that it's actually 5%, right? It could be 4%. It's just that 5% sounds like a reasonable answer, right? So there's no guarantees on this unstructured data that you're actually like producing factual structured data. Second, and this is the most obvious, is knowledge is limited to the data you're trained on. So the vast majority of LLMs are trained on like common crawl corpuses, right? So basically, take all the text data on the internet, feed it into your LLM, and that's like a reasonable approximation of human thought and speech. But that's actually somewhat limited, right? If you want an LLM to perform well on medical questions, then maybe ingesting all of PubMed would be helpful. Or if you want the LLM to perform well on legal questions, then maybe you actually need to feed it legal documents. And I think most people see that as obvious. I think what's less obvious is a lot of these public documents are not as public as you would think, right? So the government provides them in theory, but in practice they sit behind FTP servers, or they sit behind registrations, or they sit behind something that means they're not included by default into sort of all these models. And then the last piece, and probably like the other most salient question in LLMs, is who actually owns the data, right? So if you scrape the whole internet, and then you build an LLM that generates music and competes with Warner Music, like, did you actually use their IP, or is that fair use? I think those are the questions that will need to be figured out, right? And I think it's very, very unclear right now. And a key challenge in building LLMs is, how do you know that the data you're using, you're allowed to be using? And taking back to the compliance point, if you're building a LLM on data for the purposes, or you're using an LLM for the purpose of investing, how do you know that data that's coming from somewhere, how do you know what even went into that? It's very difficult. And so I'll move to a quote, and this is probably the only thing Databricks and Snowflake agree on. And I think the one thing they agree on is that more data leads to better outcomes in models, right? And so Databricks had this example of Dolly, where they took an old model, an old generation model that was open source, and they just fed it a larger, more custom data set of human speech. And then Dolly ends up performing approximately as well on conversational topics as GPT-3, right? And it was impressive because their model was so much simpler, but they just had like unique data, so to speak. So I think in some ways, more data or more interesting data matters. And I think that Snowflake, in a recent podcast, Torsten was quoted as saying, look, publicly available data is one thing, but what about proprietary data? And how can that generate a lift in your LLM performance? And other companies are realizing this too. Reddit has started charging for API access. Twitter has started charging for API access. Stack Overflow has realized, hey, we have this whole corpus of questions being asked and answered on our platform. We used to just give this away, right, and monetize in other ways. But all of a sudden, no, you have to pay us if you're going to train on this. And this goes back to the data ownership thing, where I don't think anybody cared if you scraped Reddit 5 years ago. It's just a random forum of memes. But today, that random forum of memes could be the difference between a very accurate model and not for certain topics. And so my point, and this is bringing it all together, is maybe the hedge funds were onto something. Maybe in this world of LLMs, external data actually becomes extremely important. That is, proprietary data gives you an advantage in training models. Your internal data gives you an advantage. Nobody else has that data. But unless you're Google, you probably have like less than 1% of the data on your customers. I mean, again, going back to the Netflix example, if you think of the machine learning problem at Netflix of recommending movies, right? I mean, how does Netflix get a bigger lift on better recommendations? I mean, they've probably been working on that algorithm for 10 years, right? Clearly, the highest lift could come from if they knew what their consumers were watching on other platforms. So the external data set. That probably produces a better lift than 3 years of research on the algorithm. And so my point is that if you combine external data, proprietary, unique external data, with internal data, you might get something unique. You also get some benefits, such as knowing that the data you're licensing is actually legal, that the person selling it to you owns it, right? And so you're less at risk than some of these folks using the models that just crawl and ingest everybody's data that leaked onto the internet. I'm so convinced about this that I sort of left my job. Now, it took a while to get to this conclusion, but I founded Cybersyn in 2022, and I left Code 2 in 21, with the mission to make the world's economic data, external data, more transparent. And I think that this data, in many ways, will be useful for all types of use cases, not investing, but policy making, business decision making, competitive analysis. And I think I see AIs and LLMs as a tailwind, an unexpected tailwind that we can provide something different. And just a quick plug for ourselves. Basically, what we do is we ingest public domain data and proprietary data. we monetize it on Snowflake Marketplace, and we make it available in Snowflake. So if you find a data set that we're providing, and you're on Snowflake, you could just in one click start querying it as if it was your table. We maintain those data sets sort of up to date. And the idea being that it cuts down on the ETL cost, right? We also normalize schemas. So when you take our data from the IRS and our data from the BLS and our data from the US Census, it's all structured the same, right? So you can compare it, you can merge it. It saves you a bit of work, and then you just query it as if it was yours, and it sort of magically updates. That's kind of like the thought process. But going back to the how to start question, again, I recommend starting with public data first. But look at public data that is truly in the public domain. So not YouTube videos or Reddit comments that might be owned by somebody else, but data sets that the government puts out that are sort of underestimated. I think the government is often underestimated and underutilized. So let me just give you some unique examples of public government data that is free, but most people don't know about. So one such example would be what I call, or what's called Form 5500 data from the IRS. And what Form 5500 is every business entity that offers benefits to their employees needs to file Form 5500. And on that form, you have to disclose what benefits you offer and what provider you use. So you basically have to explain, do you use United or do you use Aetna? Do you use, if you offer life insurance, do you use Liberty Mutual or do you use Aflac, right? And so the market share for insurers for any company, right, and lead gen for any company is actually publicly available and mandated by law. And this data is free, right? So the level of detail you could get there is actually quite impressive. Another great example that most people don't know about is every residential home transaction in the United States, every deed transfer is a public record. And in most counties, not only is that deed transfer a public record, the price is a public record, and the lender, so the bank extending the loan, is a public record, right? So you could get a view of every home being sold and who's lending and what do those portfolios look like. It's all public domain. Other public domain data sets that might be more obvious are things like patents, right? That include a tremendous amount of written textual knowledge that could be very useful in some of these models. So my suggestion for anybody looking at external data is start with what's clearly in the public domain. I think in some ways we're underutilizing our own government in this way. And then I think the second piece of advice is build a framework for evaluating data, right? And this framework is, it's easy to just spend money. And so you really have to say, OK, what is the key KPI I'm modeling? Like, in the hedge fund use case, people would say, OK, how accurate can I measure inflation? And let's say using some data set, I can get to a 2% error rate. When I evaluate a net new data set, I say, OK, how much does it bring down my error rate? If I go from 2% to 1.5%, OK, it's a 50 bip increase. And maybe a 50 bip increase in accuracy is worth X to me. And so there's a very rigid framework of like, I know I'll buy a data set when it meets these criteria. And you can apply that same framework then to compliance, to data reviews, and sort of standardize this acquisition process. So I think that's it for me. Hopefully I've taken these two very disparate topics, the story about hedge funds and the story about LLMs, and weaved them together, why I think they kind of rhyme, and sort of explained a little bit of a tailwind. If you're interested or want to learn more, follow me on Twitter. I tweet basically about external data, data as a service, unique data sources we find, and then the company's Twitter is Cybersyn Inc. And with that, I'll just push it off to questions. OK.
In using this outside of finance with the customers you're building in your new business, how do you have them think about use cases, and do you have any sort of like processes around that? And like it's kind of you kind of start with the data, but also helps lots of times start with kind of a thing that you think is going to be helped by the data, and then think about the data. And obviously those are all very iterative. So I'm just kind of curious what your process is there.
Yeah. So I think that I wouldn't start with the data. I would start with like what business problem or what policy problem are you trying to solve, and then is there a data set that answers that question? In my experience, beyond the investment use case, the largest buyers of data seem to be in CPG and in pharma. And there's relatively well-trodden sort of objective functions, right? So I mentioned site selection in pharma is one. In CPG, market share impact is another. Pricing optimization at the retailer level is a third. So there's these kind of like well-trodden paths that people sort of, just like the Excel modelers in investing, that people sort of do as a job. And in effect, they are synthesizing information themselves. They're just doing it in their mind or in Excel or whatever. And then we just try to say, okay, well, you're really answering this question. What if you took sort of a data-driven approach?
Any other questions?
Hey, thanks for the talk. But you weaving together the data in LLMs and saying, look, these are open data sets. You include them in the LLM. It makes it specific to the problem that you're trying to solve. And you motivated well with DALL-E and Databricks and whatnot. But one question is, once you start using LLMs, the question of performance comes up very quickly. So I wonder if for a use case that comes to mind for you, if you have a good tip on how do you measure performance of LLMs?
Yeah, I think it has to come down to like this kind of KPI function, like an objective function. Because I actually think, and Matej, the Databricks founder, talked about this in the podcast that I quoted from, that people right now judge LLMs based on like their ChatGPT experience. So it's sort of like, does this sound more believable or does this sound more human? I think that's probably not a great way for enterprise use cases to do it. I think you have to say, look, what am I really trying to get from this machine learning model, right? Or from this model, and then sort of if I add this data set, like how do I perform on that specific metric, right? And so like a clear example in say CPG world would be, okay, like I'm trying to manage my inventory so I have the least out of stock kind of situations possible, right? And so whether I use an LLM for that or not, I think it's very clear that like the metric is like, okay, how many stores are out of stock unintentionally like per week, right? And then I think what you want to do with an external data set and say like, okay, if I like include this external data set in my model, how much lift do I get?
Okay, that's fair.
Okay. Well, thank you all for coming. Thanks, Alex.
Thank you.